So you think you know about mortgages? Well, think again. There are many situations in purchasing a home for different people. And as a result, what happens is there's many kinds of mortgages. Now, not every mortgage loan officer has a specific loan to meet your needs. And in many cases, they do have some different mortgages to more or less cover your needs. However, they do have different investors so that there are different requirements for credit and for debt to income ratio and other things. So it's always good to check with more than one mortgage broker when you're doing your home loan. The FHA loan is probably the most common home loan for people who have a minimum down payment. And as you can see, there's a minimum of 3.5% down and a credit score of 580. And typical debt to income ratio is anywhere between 35 and 41. Some are even higher. You may get turned down by one lender if their credit score is under, say, 600. Another one might allow that because they each have different investors that have different requirements. So you may get turned down by one company or lender, and another one may find it acceptable and work with you. So it's also able to use down payment assistance programs in the FHA program. And as I said before, it's the most common. There are many other programs that include financing and down payment assistance and other kinds of programs as well for financing your home. USDA loans are primarily used in rural areas, even though they may be located right outside of some city or urban area. The VA loans, of course, are for vets and can provide up to 100% financing as well. But there's some down payment assistance programs that are specific to first responders or first-time home buyers or others. And of course, there's always grant programs, and some of those are for maybe a portion of the mortgage to assist with down payment assistance, or something like even the Tunnel to Towers program for first responders and veterans who have lost spouses in service. So there's a lot of different kinds of ways to finance your home. Then, of course, there's conventional loans, and they require anywhere from 3 to 20% down, which is more than the FHA loans. However, the conventional loans require less mortgage insurance on them. And they come in both fixed and variable, and they're a little bit more flexible than the FHA for appraisal purposes and offer limits as well. And that's quite common with people who have a significant down payment to use. If you have a piece of property already, the bridge loan or private bank loan is probably the answer for you, because what you're doing is you're putting up your land as collateral and getting draws as the construction proceeds to complete the project. Once the home is complete, then the loan is turned into a regular mortgage loan. So that's pretty much how that works. Hard money lenders are usually cash lenders that will lend you money for a short period of time to perhaps fix up a house or make some improvements. However, that's a very costly way to do it because the time is short, and B, the interest rate is usually quite high for that kind of a loan. The HELOC is the home equity loan that you're borrowing on the equity within your home. And that's typically to make repairs or do some of those kind of things, but it ends up to be like a second loan on your property. So that's pretty much how the bank works, and it's a kind of a mortgage as well. The reverse mortgage is similar to the HELOC in that it will allow you to take money from the equity within your home, and it is age related, as it's you have to be retirement age to do so, and the mortgage amount doesn't have to be paid out until the last person leaves the home. The HECM or H4P program is for retirees who have a large sum of money and want to put a down payment on a house and no longer want to have a mortgage payment. Basically, they can live there until they're out of the home and don't have to pay additional mortgage payments on the home as long as they live. So it can be a great program for those who wish to do some financial planning, as it gives them more income to spend over a period of time, or they can, in addition to that, pay a smaller amount, just the interest, and it becomes almost an interest-only loan. So those are different ways in which they can use it. Very flexible kind of program. Then, of course, there are commercial loans, and most of the homeowners won't be involved with commercial loans unless they're uh, having rental properties and purchasing rental properties or doing some things like that. But we're not going to cover that very much because there's many different kinds of commercial loans as well.